All right, imagine a bank that literally just hit a 52-week high, successfully finished its largest ever share buyback, and is sitting comfortably on the throne as Europe's most profitable bank. You'd probably think the market would be in unanimous agreement about its future, right? Well, with BBVA, that couldn't be further from the truth. Analysts are completely split right down the middle on this one. You've got some pounding the table screaming buy, while others are aggressively raising the caution flag and saying hold. In this explainer, we're going to unpack exactly what is driving this stock, uncover some of the hidden regional risks, and figure out exactly what the smart money is doing right now.
So here's our roadmap for this explainer. We'll start with the numbers that matter, dive into the bull case, flip over to the bear case, check out what the consensus says, and finally, wrap things up with the final verdict.
Let's jump right into Section 1, the numbers that matter, setting our Q2 2026 baseline.
Okay, the sheer scale of these baseline numbers is honestly staggering. We're talking a net profit of 3.06 billion euros, and that's driven by a massive revenue print of 10.51 billion euros. Break that down and it translates to an earnings per share of 62 cents. These aren't just, good numbers. These are foundational, powerhouse metrics. They show the bank is absolutely firing on all cylinders when it comes to raw revenue generation. But to truly understand why the market is paying such close attention, we've got to look past the top and bottom line. We need to talk about efficiency.
Now, before we hit the big headline number, let's quickly clarify the metric that actually matters most here, return on tangible equity, or ROTE. Simply put, this is a crucial efficiency metric that measures a bank's profitability based strictly on its tangible capital. Basically, it tells us how effectively management is using shareholder money to generate a profit. The higher this number, the better the bank is at turning its core capital into cold, hard cash.
And that brings us to 24%. This number is the exact reason for all the market hype. 24% is the highest in all of Europe. That is a staggering level of profitability. And get this, management didn't just stop there. They recently raised their full year 2026 guidance to an impressive 21% ROTE. That's no fluke, guys. That is just pure, high-level execution by the management team.
This leads perfectly into their shareholder return strategy. BBVA recently wrapped up a historic 3.96 billion euro buyback, literally their largest ever. But they didn't even take a breather. They instantly pivoted and launched a brand new 2 billion euro program. The first 1 billion euro tranche of that just kicked off on August 5, 2026. This shows continuous, aggressive momentum in buying back their own stock. And as we know, that reduces the number of shares on the open market, which inherently makes each remaining share a bit more valuable.
So, what does all that execution and buyback activity actually mean for you? Well, it translates to a forecasted 7 to 8% annual total shareholder yield. When you combine the dividends they're paying out with the stock they are aggressively buying back, income investors are looking at a really serious cash return. That is a pretty massive baseline cushion, if you ask me.
Moving on to Section 2, the bull case, and specifically, the Mexican catalyst.
Here's the thing about BBVA. Its success is heavily weighted toward one single country. Mexico is the absolute powerhouse for this bank. Mexico alone is expected to deliver a full 50%, half of BBVA's total group earnings this year. The rest of the entire world combined makes up the other half. They aren't just participating in the Mexican market, they are the undisputed leader there.
And the experts are well aware of this dominance. The financial firm Jefferies specifically calls BBVA's Mexico franchise a key divergence factor. What they mean is that this absolute stranglehold on the Mexican banking sector is exactly what separates them from all their other European banking peers. It's basically their ultimate competitive advantage.
But of course, the real question is, what are you paying for that dominance? Well, despite having the highest profitability in Europe and that dominant Mexican franchise, BBVA's valuation sits at roughly 9 times its 2027 projected earnings. Meanwhile, the European banking average is actually higher at 9.5 times. So the bull's core argument is right here. You're getting top-tier, best-in-class profitability at a literal discount compared to average banks. You really don't see that combination every day.
To quickly summarize what the heavy hitters are saying, Goldman Sachs, JPMorgan, and Jefferies are all projecting an 11 to 15% upside for the stock, with price targets sitting somewhere between 26.8 and 28.3 euros. Their thesis is incredibly straightforward. First, they think the market still hasn't fully priced in the premium value of that Mexican operation. And second, that aggressive buyback momentum we just talked about, that provides a really solid floor under the stock price. Essentially, it's a discount paired with a built-in safety net.
All right, let's flip the coin. Section 3, the bear case, and the red flags we need to watch out for. The starkest warning here actually comes from UBS. They explicitly flag BBVA's exposure to Turkey as a material risk to the disinflation path. Now, why is that? Well, BBVA owns a major Turkish bank called Garanti, and right now, Turkey's dealing with some intense stuff. Extreme inflation, massive currency volatility, and wildly fluctuating energy prices. If things go sideways in Turkey, it could severely drag down BBVA's otherwise stellar group performance.
And the caution doesn't stop with Turkey either. Let's rapid fire through the rest of these bear arguments. First off, UBS notes that earnings momentum is actually stalling. They say earnings per share upgrades have flatlined. Because BBVA has been delivering such ambitious guidance, the bar is now set exceptionally high for any positive surprises. On top of that, while the 2027 forward PE looks cheap, bears will point out the current valuation isn't exactly dirt cheap. It's trading at 13.3 times normalized PE and is sitting right near its all-time highs. Because of all this, we've seen recent downgrades to hold by both Deutsche Bank and KBW, which implies about an 8% downside from current levels. Basically, the bears are arguing that after such a huge run-up, the easy money might already be gone.
Which brings us to Section 4, what the consensus says and analyzing this major market split. You guys, there is a massive tug-of-war happening on Wall Street right now across the 23 analysts covering BBVA. If you just look at the average price target, which sits at 22.54 euros, that implies an 8% drop from current levels. But honestly, that average completely masks the drama behind the scenes. You've got 15 aggressive bulls projecting a 15% upside, going head-to-head against cautious bears who see a 10% downside. The market is entirely fractured on what happens next. Ultimately, the consensus sentiment really boils down to this one single thought. The easy money has been made. Sure, that 7 to 8% total shareholder yield provides a fantastic cushion if you're a long-term investor. But if you're jumping in right now expecting another massive 20% rally, you are basically betting on absolute, flawless execution in Mexico, and you're praying that there are absolutely zero blowups in Turkey.
All right, let's wrap this up. Section 5, the final verdict and analyzing the trade-offs.
Let's break this down based on 3 distinct investor personas to see where you might fit in. If you're a value investor who really believes in the long-term earnings power of Mexico, BBVA offers a pretty compelling risk-to-reward ratio, and it's heavily supported by that strong buyback backstop. But if you're a growth investor hunting for the next rocket ship, the catalyst for massive sudden upside might be pretty limited from here on out. And finally, if you're a risk-averse investor, extreme caution is warranted, simply due to the unpredictability in Turkey and the fact that the stock is hovering near all-time highs. So the objective final synthesis from our sources is this. Right now, BBVA is a hold, with a tilt to buy on dips. The fundamentals are incredibly solid and the yield is super attractive. But the smart play here seems to be waiting for a 5 to 10% pullback before deploying any new capital, all while keeping a very close eye on Turkey and any Mexican peso volatility.
And that brings us to the end of our analysis. Thank you so much for joining this explainer. Now, I want to turn it over to you. Based on the data we just went through, are you buying BBVA right here at the highs, or are you patiently waiting for a pullback? Let's spark some debate. Drop your strategy in the comments below. Keep learning, stay focused, and I'll catch you in the next explainer.